Ever wonder why interest rates are always in the news? It's not just banker talk, it affects your wallet every day. Think of the Reserve Bank of Australia's interest rate as the main dial controlling our economy's speed. When you borrow for a house or save money, the interest you pay or earn is tied to this rate. The RBA's job is to adjust this dial, keeping the economy from running too hot or too cold. The cash rate, set by the RBA, is the base rate banks use for overnight loans, and it influences all other rates, from mortgages to credit cards. By raising or lowering the cash rate, the RBA encourages people to spend or save, steering the economy towards stable growth. Imagine the economy as a car. If it's speeding, prices rise too fast, inflation. The RBA brakes by raising rates, making borrowing costlier and slowing spending. If the economy's stalling, the RBA accelerates by lowering rates, making borrowing cheaper and boosting spending. Every RBA meeting is watched closely because their decision ripples through the financial system. It can change your mortgage payments, affect business hiring, and even shift the value of the Australian dollar. Understanding these decisions is like having a weather forecast for your finances. It helps you prepare and make smarter money choices. That's why interest rates matter to everyone, not just economists. The RBA's decisions shape the financial climate for all Australians. On December 10, 2025, the Reserve Bank of Australia made its final call for the year. The cash rate stays at 3.6%. For homeowners and businesses, this was a relief. No higher loan repayments, at least for now. Experts saw this pause coming. The RBA had already raised rates several times to fight inflation since 2022. Those hikes made borrowing tougher, but they were meant to cool spending and tame rising prices. By holding steady, the RBA signals it thinks rates are high enough for now, but it's not fully convinced inflation is beaten. The bank faces a tough choice. Inflation is still too high, but the economy is showing signs of strain. Raising rates could hurt jobs and growth. Cutting them could let inflation surge again. So, the RBA chose patience, waiting to see how past hikes play out. It takes time for rate changes to affect spending and prices. By pausing, the RBA can watch how inflation and the economy respond before making its next move. This cautious approach gives everyone, households, businesses, and the bank itself, some breathing room. The RBA is buying time to gather more data and avoid a costly mistake. For now, stability is the strategy. What is inflation? Simply put, it's when prices rise and your money doesn't go as far. If your groceries cost $100 last year and $105 now, that's 5% inflation. Your dollar shrinks. The RBA aims to keep inflation between 2% and 3%, enough for growth, but not so much it hurts. Right now, inflation is still stubborn, especially for services like haircuts, dental visits, and car repairs. These sticky prices aren't falling as fast as goods. High inflation erodes savings, makes planning hard for businesses, and hits people on fixed incomes the hardest. That's why the RBA raised rates aggressively, to slow spending and bring prices under control. Higher rates make borrowing costlier, so people spend less, easing price pressures. The December pause shows the RBA is still worried inflation isn't tamed. Cutting rates now is off the table. The risk of inflation flaring up again is too high. The fight isn't over, and the RBA is staying vigilant. Until inflation is clearly under control, expect rates to stay put. Your money's value depends on it. The RBA isn't just fighting inflation, it's also watching the health of the whole economy. Australia's economy is a tale of two halves. Some signs are strong, others are worrying. On the bright side, the economy is growing, businesses are investing, and property prices are holding up. But many households are struggling. Higher mortgage repayments mean less money for everything else. Discretionary spending, on things like dining out or holidays, is weak, and families are feeling the pinch. The job market, once booming, is losing steam. Hiring is slowing, and businesses are more cautious. This is an early warning that the economy could be slowing too much. The RBA's dilemma: raise rates to fight inflation and risk hurting families and jobs, or hold steady and risk inflation sticking around. A rate hike now could tip the economy into a downturn. The goal is a soft landing, slowing inflation without causing a recession. It's a tough balancing act, and the RBA is treading carefully. Every move has consequences for households, jobs, and growth. That's why the bank is so cautious. The stakes couldn't be higher. The RBA is walking a tightrope. One misstep could mean recession or runaway inflation. Raising rates risks pushing families and businesses over the edge, leading to job losses and a deeper slowdown. Cutting rates could reignite inflation, undoing all the hard work so far. That's why the December decision to hold steady was so significant. The RBA doesn't want to tip the economy into recession, but it can't declare victory over inflation yet. For now, the only safe move is to wait and watch. This neutral stance means the bank isn't signaling a hike or a cut. It's ready to move either way, depending on the data. The RBA is being patient, letting previous rate hikes work through the system. It's a strategy of caution in a world full of uncertainty. The bank's credibility depends on getting this right. Every decision is about balance, protecting jobs, savings, and the value of your money. The RBA's next move will depend entirely on what the numbers say. For now, patience is the plan. With rates on hold, the RBA has entered a wait-and-see phase. Over the coming months, the bank will watch inflation data, especially the Consumer Price Index, for signs of progress. If inflation stays high, pressure to raise rates will return. If it falls, the RBA can relax. The job market is another key focus. Weakening employment could tip the balance. Wages matter too. They need to rise enough to help with living costs, but not so much they fuel inflation. Household spending and consumer confidence will also be closely tracked. All this data will shape the RBA's next move in early 2026. Until then, the bank is gathering evidence before making any changes. The RBA isn't alone in watching the numbers. Australia's big banks and financial markets are too.
The big four banks agree rates will likely stay at 3.6% for a while, with no hikes expected soon. They expect the RBA to wait for more inflation and jobs data before acting. This consensus gives households and businesses some certainty. No rapid mortgage increases for now. Financial markets mostly agree, but see a small chance of another rate hike if inflation proves stubborn. Some, like Westpac, mention a possible rate cut, but only if inflation drops much faster than expected. The outlook is uncertain, but most experts see a long pause ahead. The RBA's next move will depend on how the data unfolds. For now, stability is the message.
Australia's economy is shaped by global events, especially what happens in the US.
Central banks worldwide are fighting inflation, but at different stages. The US Federal Reserve has started cutting rates as their economy slows, but remains cautious. The RBA, however, faces more stubborn inflation, especially in services, so it's not ready to follow the Fed's lead. Global risks, like supply chain disruptions or a slowdown in China, could affect Australia, but so far, the impact is limited. The RBA is watching these risks, but its main focus is on local inflation and jobs. Global trends matter, but Australia's path is unique. The RBA will chart its own course, based on what's happening at home. International moves are just one piece of the puzzle. The real test is how Australia's own economy responds.
So, what does all this mean for you in 2026? The key word is patience. The RBA is holding steady, waiting for clearer signs before making its next move. This gives households and businesses a rare window of stability to plan ahead. The hope is for a soft landing. Inflation falls, jobs hold up, and rates can eventually come down. But the RBA won't cut rates until it's sure inflation is truly under control.
Now's the time to review your finances and prepare for whatever comes next. Watch the same things the RBA is watching: inflation and jobs data. The bank's cautious approach is about avoiding mistakes and protecting the economy. By being patient and data-driven, the RBA hopes to steer Australia to stable growth. For now, all eyes are on the numbers.